Hey, what's up? Welcome to daytradetowin.com. Today, let's talk about volume. I've mentioned volume and the importance of analyzing volume a few times so far in this series, so today I want to focus on volume. So first of all, what is volume? Well, volume is the number of shares or the number of contracts that are traded during a time period, like one candle, for example. In Forex, you don't have volume, you don't have the information about how much was traded at any given time, but most other tradable instruments will have volume, like stocks, futures, or commodities. In Forex, you will have tick volume, showing you how many ticks took place during that time, but that's slightly different. Anyway, if you think about stocks, for example, every time somebody buys or somebody sells any number of shares, the number of shares are added up. So in stock trading, you have deals taking place all the time. Somebody buys one share of Apple, another one buys 1,000 shares of Tesla. Warren Buffett buys Coca-Cola for $1 billion. All of those shares are added together, and what you get at the end of the day, that's the volume for that day for that particular stock. The number of shares that changed hands. Of course, you can, and as a day trader you should, also split the daily volume into hourly volume, or the volume for 1 minute or 5 minutes or 15 minutes. So volume is very useful for day traders as well. It's not just swing traders that would use volume. When you look at a chart that displays volume, you will usually see the volume at the bottom of the chart, like bars sticking up. It's either called a bar graph or a histogram. I have no idea which, it's one or the other. During my time at the university, some of the classes were more boring than others. Statistics was something that I slept through most of the time, so I got bar graphs and histograms mixed up, and the professor probably thought I was pretty stupid. So guys, do yourself a favor and pay attention to what your statistician tells you. Okay, enough of the sidetrack. The volume is displayed as a bar graph, and in layman's terms, that means these bars sticking up from the bottom of the chart. Together with the candles, the volume will give you a lot of information. By analyzing trends and changes in the character of the volume, together with analyzing the movements in price, you can get a better understanding about the relationship between supply and demand. As you learned in a previous episode, the one with the silly cat, it's the relationship between supply and demand that determine if the prices are going up or if the prices are going down. And all good economists will tell you that if demand overcomes supply, then prices will increase. And if supply overcomes demand, then prices will decrease. So if there's huge demand for something, then the seller can increase the price and people will still want to buy. Or there can be limited demand, but if there's not a lot of supply, the prices will still be high. So for example, scarcity can lead to high prices. When I was looking to buy a vintage German sports car, now there are not a lot of those lying around, so you cannot just go to any used car salesman and ask for a classic Porsche. Even if you found one, it might not be in that good condition. So at any given time, there are not that many vintage Porsches in top condition. So there's limited supply, there's also limited demand, but prices are still high. There are not that many buyers, prices are not extreme, but they're still elevated. So each volume bar at the bottom of the chart corresponds to a candle in the candlestick chart. When you have many candles in a chart, you will also have many volume bars. To explain the simplest way to analyze the volume, I sometimes use the car fuel analogy. You see, you can consider the volume bars to show you how much fuel that the car consumes, and the price itself is the vehicle that is moving. You would expect the fuel consumption to increase when the car goes fast, and when the car slows down, you would expect the fuel consumption to decrease. So when you have big candles, up or down, you would expect big volume. When you have small, narrow candles, the volume should be less. There are two main ways you can gauge the volume on up waves. Either the volume increases on the up waves or it decreases. If the volume increases on the up move, then you can be fairly sure that there's good demand. When you have a series of up moves or up waves, if the volume increases on the up moves compared to the pullbacks, then you can be fairly sure that the series of up moves will continue. The pullbacks will have lower volume in a healthy uptrend. there is not as much selling as there is buying, so when buyers enter the market on the up moves, the volume should increase if you have a healthy uptrend. But if the volume diminishes on the up move, then there is no more demand. The market is running out of steam and could well turn into a downtrend soon. Sometimes there's a period of equilibrium before the market moves from an uptrend to a downtrend. During that period of equilibrium, the market is in a horizontal channel. If the volume is picking up on the down moves and decreases on the up moves, then chances are that the market will start a new downtrend soon. Same thing in a downtrend when you have price waves moving lower and lower. If the volume picks up on the down moves and decreases on the rallies, then it's likely that the downtrend will continue. If the volume starts to dry up on the down moves, then after a period of equilibrium, the market will form an uptrend. That's the very basics of volume analysis. That's a bite size. In the next few videos in this series, we'll delve further into volume analysis and then also start combining the volume with the analysis of candles and get a good understanding about how you can use this information in your price action trading. So make sure you subscribe to the next videos in this series. We'll also do live trading and other great videos. So subscribe now. Bye bye.